Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And today we're going to talk about a topic that really hits home for many of the younger physicians out there, and that's student loans. And we don't need to remind you about the stats of the average student loan burden for physicians, but it's safe to say that for many young doctors, student loans are the single biggest topic and planning item when it comes to their finances. And it's not just the student loans directly, but also some of the related questions that come along with them. Things like, how should I balance paying back my student loans with saving and investing for the future? How should I look at the student loan debt relative to the mortgage debt? Should I pay ahead on my loans or save more for retirement and other goals? And other questions like that. And it's an area where the stakes are really high. I mean, given the numbers we're talking about, the difference between good and bad student loan management can literally amount to hundreds of thousands of dollars. So getting a good plan in place, then executing it is key. And really, for many people, the toughest thing is just figuring out where to start and coming up with that game plan. So that's going to be our focus for today. And a good way to think about this is like driving somewhere for a family vacation. Say you're driving from Michigan all the way down to Florida, which, Andrew, hopefully you and Jenny aren't planning to do any 20-hour drives with Grant anytime soon.
Yeah, definitely not in the near-term plans. Although I will say that the car seems to be the only place where he actually gets deep sleep, so maybe we'll have to try it.
Now, one option when you're doing this would be to not put much thought into it and just start driving. So you head south and try to follow the street signs as best you can and stop for directions along the way as needed. And you'd probably end up making some wrong turns. Maybe you'd have to backtrack several times and spend extra time trying to find a hotel or two along the way, but you'd eventually make it to your destination. However, a better option would be to take some time on the front end to come up with a plan, including mapping out the route you're going to take, figuring out how many hours you'll drive each day and exactly which hotels you'll stay at, and then using your GPS to guide you along the way. Both approaches would likely end up working in the sense of helping you make it to your final destination, but the second approach is much more efficient and is going to save you time, money, and lots of headaches along the way. And it's the exact same way with your student loans. You could go the first route and just make the payments that you're told are required for your loans, and you'll eventually pay them off. Or you could come up with a plan and be strategic about the way you manage your loans.
Yeah, that brings us to our first point, which is to be intentional with your student loan game plan. And this will be a constant theme you hear from us, which is that with all areas of your financial life, there will be trade-offs. So you need to understand your options and then be intentional with how you address that area of your financial life. And you'd be surprised, or maybe not surprised, by how many younger physicians we've talked with that have a big student loan burden, but haven't done anything with their loans up to that point. And it kills us to see that, since we know what all those years of letting their loans go on autopilot has cost them. In terms of both the financial costs, but also the opportunity cost of missing out on being able to save and invest more towards some of those other goals, or even just to spend more. So it starts with being intentional with your loans and putting together a plan. And the way to approach this is like a decision tree, where you ask successive questions and your options change depending on the answers to those questions.
And with that in mind, one of the first and most important questions you should ask is whether your loans are public or private. And the reason this is so important is that your options and your strategy are going to be different depending on the answer. And just to clarify the two types, so public loans are loans from the government, while private loans are from private financial institutions. And generally speaking, public loans have more flexibility and options, and the most significant being the potential to have them forgiven through public service loan forgiveness, which we'll talk about in a bit. Public loans also tend to carry additional consumer protection benefits related to things like disability or death, and in certain cases, they're subsidized for certain periods of time. And they also tend to have more repayment options, including the potential for income-based repayment, where your required payment is linked to your income. So the lower your income, the lower your required payment, and vice versa. So step one when putting together your game plan is to figure out whether your loans are public or private.
Yeah, and we'll talk about both types of loans here, but let's start with assuming your loans are private. If this is the case, the situation tends to be a bit more straightforward, since there aren't as many options because private loans are not eligible for public service loan forgiveness. So you know that you're going to have to pay back your student loans, which means your goal should be to minimize the amount of interest you pay on your loans. And the best way to do this is to look at your options for refinancing. And there are a couple different ways to go about this. On one hand, you could check with individual lenders to see what interest rates they would offer you and do more of the legwork to shop for the best offer. Or alternatively, there are some companies who act as brokers for student loan refinancing, where they're able to compare the options from many different companies to save you some time and effort. And the nice thing about these brokers is that there's no cost for you to use them because they get paid by having you refinance with one of the 10 or 15 lenders that they have available. So if you do have private loans, it's worth at least looking at your refinancing options, especially right now since interest rates remain near historically low levels. And you may or may not be able to improve your rate, but there's no downside in checking out your options. And the nice thing is, unlike a mortgage, there's no cost to refinance your student loans. And when thinking about refinancing, there are a few things to keep in mind. When lenders decide what interest rate to offer you, one of the biggest things they look at is your debt to income ratio. So in simple terms, you divide your total debt by your total income. So over time, as your income increases or your debt, whether that's student loans, your mortgage, or car loans decline as you're making payments, you become a less risky borrower in the eyes of a lender and might qualify for a lower interest rate. So it's worth checking periodically, even if you've already refinanced your loans at some point in the past. And another way to potentially improve your debt to income ratio and creditworthiness in the eyes of a lender can be through having a cosigner. So when someone cosigns for your loans, they agree to back them and are also on the hook for them from a liability standpoint. So there are only certain situations when you would want to consider having a cosigner, but we've had some situations with clients where by having one spouse cosign for the other spouse, the spouse with the student loans was able to get a better interest rate. And one other thing to keep in mind for refinancing your loans, when you go to refinance, the lender will give you different options for repayment terms. So that could be 3 years, 5 years, or 10 years. And so people often wonder, what option should they go with? And like most things with financial planning, the right answer depends on your unique situation, but there are at least a couple key parts you should consider. On one hand, there's the pure numbers. Typically, the shorter the time period, the lower the interest rate, which means you'll pay a lower amount in total interest as you pay off the loans. However, the shorter the time period, the higher the monthly payment, which means you'll have less money available to save toward other goals like retirement or just to spend in general. And this is why you have to take into account your personal cash flow situation to balance what monthly payment you are comfortable with versus the interest rate you get when you refinance. And we generally recommend people do the shortest time period they can without stressing their monthly cash flow or sacrificing their ability to save for or spend on other things just because they're paying off their loans aggressively. But with that in mind, a common strategy we'll recommend, just given how low interest rates are, is that instead of doing a 5-year refinance to get the best interest rate, you could do a 7-year refinance, which gives you a slightly higher interest rate, but gives you more flexibility in terms of your monthly cash flow. And you can always pay ahead on your loans, but by doing a longer term refinance, you at least give yourself more flexibility on a monthly basis with your cash flow.
So that covers private loans, but as we mentioned, if your loans are public, you're going to have more options and decisions to make. The first one being whether or not you're going for loan forgiveness. Now, there are a few different loan forgiveness programs out there, but the one most relevant for physicians is Public Service Loan Forgiveness, or PSLF. And at a basic level, this program says that if you're employed by a nonprofit or government agency and meet all the annual requirements and file the necessary forms, after making 120 monthly payments, or 10 years worth of payments, you're eligible to have your federal loans forgiven by the government. And the nice thing is, loan amounts forgiven through PSLF are not taxed, which is different from some of the other forgiveness programs. And it's especially relevant for physicians, since you'll likely be in a relatively high tax bracket when it comes time for forgiveness, since you'll be done with training at that point. So what are the requirements to qualify for PSLF? Well, as mentioned, the first one is that you have to be employed full-time by a nonprofit, also known as a 501c3, or government agency. When people think about qualifying employers in our geographic area, Michigan Medicine typically comes to mind, but not everyone realizes that most of the big health systems around here are all nonprofits as well. So that includes IHA, St. Joe's, Beaumont, Henry Ford, and more. So whether you're currently working at one of these or you're in training and looking at your options for after training, know that a lot of different employers would qualify. And as a side note regarding the definition of being employed full-time, this means meeting the employer's definition of full-time with a minimum of 30 hours a week. So keep that in mind if you're thinking about working in a partial capacity at some point. Another requirement for PSLF is that your loans are federal direct loans. There are certain types of federal loans that won't qualify for forgiveness until they're consolidated into a federal direct loan. So sometimes you have to consolidate your federal loans, which involves filling out a specific application form. But if you are going to do this, it should be done as early as possible since your PSLF payment count resets when you consolidate your loans. A third requirement for PSLF is that you're in an income-driven repayment plan. There are several different options when it comes to income-driven repayment plans, including pay-as-you-earn, revised pay-as-you-earn, income-based repayment, and income contingent repayment. But you have to be enrolled in one of these for your monthly payments to count toward your PSLF total. So once you meet these three requirements, your loans qualify, your employment qualifies, and you're in an income-driven repayment plan, you have to then make 120 qualifying monthly payments before your loans are eligible for forgiveness. And in order for your payments to qualify, you have to file a form each year to verify your income and family size. The calculations for your required income-driven repayment are based on these factors, so the government wants you to update them each year. Another thing that isn't necessarily required each year, but is a best practice, is to file your employment certification form annually. And this verifies your employment, so the government knows that you remain employed at a nonprofit or a government agency. And it also updates your qualifying payment count, which helps you track your progress toward those 120 qualifying payments. And as a side note, we always recommend keeping track of all payments, communications, forms, and confirmations related to your loans, because the loan servicers for PSLF are government agencies, so they're not always perfect when it comes to record keeping, and it's good to have a backup documentation in case you ever need it to verify or prove anything. And one final thing, which doesn't come into play until the very end of the PSLF process, but you want to make sure you remain in qualifying employment both when applying for and receiving forgiveness. Now, I know this all sounds like a lot, which it definitely is, since the government has a lot of hoops to jump through and boxes to check to qualify for PSLF. But to help simplify the picture, we put together a one-page resource called the Public Service Loan Forgiveness Checklist, which we'll make sure we link to in the show notes. And it basically boils this all down into a concise overview of all the requirements to qualify for and then receive forgiveness.
Yeah, now, public service loan forgiveness is certainly a popular and sometimes controversial topic, and we know this is typically the bigger stressor when it comes to finances, given the dollar amounts at stake. So we want to take a moment to address some of the common questions that we hear. And one of the biggest questions is, will public service loan forgiveness still exist when it's time for you to receive forgiveness? And this question comes up most frequently because there tends to be a fair amount of skepticism around PSLF, which is understandable for a couple reasons. PSLF can often seem too good to be true to have potentially hundreds of thousands of dollars worth of loans forgiven as a high-earning professional, especially given some of the suggested changes from politicians around PSLF. The other stressor is that going for PSLF can sometimes feel like going out on a limb and taking a risk that your loans will actually be forgiven when the time comes. And the reason for this is because of the number of boxes you have to check to make sure you continue to meet all of those requirements and are eligible for forgiveness. And while we would never make any guarantees around PSLF, we'll at least share our perspective. And regarding the sustainability of PSLF, who knows how it could change over time with different political administrations. But if at some point it does change, like most changes to legislation, there typically is some type of grandfathering in for the people, which in this case would likely be the existing borrowers pursuing PSLF. And then regarding the likelihood of actually having your loans forgiven when the time comes, I think a lot of people were scared by some of the headlines following the first round of people going for PSLF a couple years back. You know, the first round of applicants, something like 99% of them got rejected. Well, what that stat didn't show is that the overwhelming majority of these people never qualified for PSLF or didn't actually meet the annual requirements. Then, of course, you had some people that said, I don't really want to pay back my loans, so they just applied without knowing anything about the program, which justifiably so they were rejected. And since the initial round of applications for PSLF, there's been more information and clarity that has come out, and many people have actually heard success stories of someone they know who was able to get their loans forgiveness. And to add some actual statistics and numbers around this, over the past 12 months, there's been $150 million worth of loans that have been forgiven through the program, which is up from $50 million in the previous 12-month period. So clearly the success rate of people going for PSLF is improving, and there's good reason to believe that, assuming you actually meet all of the requirements, your loans will be forgiven. Now, that being said, for the people who are going for PSLF but are still skeptical about it, there's a way you can at least hedge your risk. And what we recommend doing is creating a PSLF side fund, which is essentially just saving to an investment account or bank account on the side, and each month you make a payment to that account that would equal the full payment if you were to be paying back your loans rather than going for forgiveness. And if at the end of the PSLF process, for whatever reason your loans aren't forgiven, you at least have this pot of money on the side that you can use to pay off those loans. And then if your loans are forgiven, you have a big chunk of money to use for other things, whether that's saving for retirement, college, buying a bigger house, or any other goal that you're saving for. So instead of worrying about the unknowns or things you can't control, we're big fans of focusing on what you can control and then planning around the things you cannot, which is why we like this idea of a PSLF side fund.
And another common question we hear is which income-driven repayment plan to choose. And as mentioned, there are several different options, and each calculates your required payment differently, but it's typically either 10% or 15% of your discretionary income, which has its own calculation. Another wrinkle is that for certain repayment plans, if you're married, you have the option to file your taxes either single or jointly, and your required payment will be different depending on which way you file your taxes. If you file jointly, your required payment will be based on yours and your spouse's combined incomes and student loans, whereas if you file single, it'll only be based on your income and loans. and sometimes there can be a trade-off between loan payments and tax payments. And if you're going for loan forgiveness, your goal should be to pay as little as possible. So you want to choose the income-driven repayment plan that minimizes your combination of loan payments and tax payments, because you always want to look at your financial picture as a whole. And as a side note, your required loan payment is based on your modified adjusted gross income, and there are certain ways to reduce it, and therefore reduce your required loan payment. And one of our favorite ways to do this is through pre-tax contributions to employer retirement plans, like your 403b or 457b. Assuming it makes sense for your situation, making these contributions will not only give you a tax deduction, but it'll also lower your required monthly loan payment.
And the last question we will touch on is around who should actually go for or pursue public service loan forgiveness. And in general, the physicians that benefit the most are those with a high amount of student loans and a longer residency and fellowship. And the reason for that is because your payments are based on your income. So the more years you have with a lower salary, like you have during residency and fellowship, the less you'll make in payments, and thus the more you'll ultimately have forgiven. So for example, if you're planning to do a 4-year residency followed by a 3-year fellowship, by the time you finish training, you'd only have to make 3 years worth of payments at your attending salary before becoming eligible for forgiveness. But as the total dollar amount that you have in student loans is lower, or your training period is shorter, PSLF becomes relatively less attractive. In cases like these, the calculations are more nuanced and requires making some assumptions and projecting out to the future. But ultimately, it is still a simple equation of how much you'd end up paying toward your loans through forgiveness versus paying them back and then deciding what you're most comfortable with from there. If you were only going to be eligible for $10,000 being forgiven, it may or may not be worth the hassle, depending on your personal preference and comfort level with the program. However, like I mentioned earlier, the higher the amount of forgiveness you may be eligible for, the more attractive it becomes to pursue PSLF.
So we know that was a pretty extensive discussion of PSLF, but it does tend to be one of the most common and confusing areas when it comes to physicians with student loans. So we wanted to make sure we covered it in detail. And going back to that initial idea of the student loan decision tree, what we just discussed covered that branch of if you have public loans and you're going for PSLF. But now we want to talk about the other branch, which is if you have public loans and are planning to pay them back. Whether that's because PSLF doesn't make sense for your situation, you're skeptical about it, or something else. So if you have public loans and you're planning to pay them back, the situation becomes similar to that of private loans, except with a few nuances. Since you'll be paying back the loans, you want to minimize your interest rate, which can be done by looking at your refinancing options. The main differences here are that when refinancing public loans, you give up a few options and benefits. And one of them is that you give up the opportunity for loan forgiveness. Once you refinance your public loans, they're no longer eligible, so you want to make sure it's your final decision before you go ahead with it. Also, public loans carry certain borrower protections that not all private loans carry, namely protection related to death or disability, so that you or your heirs are not on the hook for your loans if you should pass away or become disabled and unable to pay them. Now, certain private lenders also provide this protection, so if this is important to you, make sure that when looking at your refinancing options, you only consider the lenders that offer it. But assuming you are comfortable with all of this, the best approach is typically to refinance your public loans with a private lender in order to reduce that interest rate. Again, similar to private loans, the same factors apply here, where your interest rate will vary depending on the term of your loan, whether that's 3 years, 5 years, 10 years. And you'll want to choose the term that fits your situation and your monthly cash flow.
And hopefully the discussion so far gives you a good idea of the questions to ask and answers when putting together your student loan game plan. And one final thing we want to cover is how to look at your loans within the context of your overall financial picture. And if you've followed everything we've covered up to this point, you'll have your game plan in place, whether that's going for PSLF or refinancing and paying back your loans. But it's common, even for physicians who have their loan strategy figured out, to still wonder how to view their loans relative to the other moving parts in their financial life, whether that's other debt like a mortgage or saving and investing for other goals such as retirement, college, or buying a bigger house. And so the question that often comes up next is, should you be paying down your loans even faster, or instead allocating more money toward different areas or goals that you have? Well, if you're going for PSLF, the situation is straightforward. You know that your loans will eventually be forgiven, so you only want to make the minimum required payment toward those loans in order to receive the maximum value of that eventual forgiveness. And the only other part we'd add is considering that PSLF side investment account. But if you're not going for PSLF and are instead planning to pay back your loans, the situation is easier around the idea of refinance your student loans, but less clear in terms of how to best use your cash flow each month with paying back debt versus saving and investing for some of the other goals that you have. And this is where balancing both the financial and softer or emotional factors come into play. And this idea of how to allocate your cash flow is something we discussed in a prior podcast. So if you haven't listened to that one yet, it's worth checking out, but I'll at least highlight some of the key points here. So on the purely financial side of the equation, you want to look at what's the best use of your cash flow. And you can do this by comparing the interest rate on your student loans to the interest rate on your other debt, as well as the potential return you could get on your money by investing it. And historically, over the long term, you'd expect to earn 10% by investing in stocks and about 5% by investing in bonds. So if your interest rate on the debt is 3.5%, well, long term, you'd be better off by investing your additional cash flow to earn that higher return versus using your cash flow to pay back your debt faster. However, with investing, as we've experienced this year, you won't get that higher return every single month or day or year, and there's no guarantee in the short run. Whereas when you pay down your debt, you're getting a guaranteed return of whatever the interest rate is on your debt. So for example, if your loans are at 3.5%, you're getting a 3.5% return by paying down your debt more aggressively, which certainly beats the roughly 0% interest you'd be getting from some of those big banks that you have your cash in currently. So while long-term, you'd historically be better off by investing the additional monthly cash flow you have versus using the cash flow to pay down debt faster, there's no crystal ball that anyone has. So some years it may be the right decision to invest, and then other years you may have wished that you just paid down debt faster whenever the market is temporarily down. So that's looking purely at the financial side, but there's also the softer and more emotional side of things. It's common to hear from physicians that they just want to be done with their student loans, regardless if it's the optimal financial decision. And for some, that extra peace of mind of having no student loans trumps any potential financial benefit they'd have by investing more and having that higher long-term return. And we always remind clients of this idea that not everything has to be the financially optimal approach. You should understand all of your options and then be sure that when you're figuring out what works best for you, it's based on your preferences and unique situation, and then you make an intentional decision on what to do. And student loans and retirement are just two aspects of your financial life. And if you're like most physicians, you have other goals that you're trying to save for, like a down payment on your forever house or future college costs. And given there are often different goals with varying time horizons, with everyone having different preferences, the goal is to prioritize out which goals are most important and figure out a plan for how you want to use your cash flow. And this idea of competing goals is why we often find taking a balanced approach to managing your cash flow is often best. And most people like to make progress in different areas, whether that's paying down their loans a little faster than they need to, saving more for retirement, but also making sure they're saving toward other goals like college or that future down payment. And it doesn't have to be all or nothing with these decisions, and it's a fluid process where you can choose each month or year how you want to allocate your cash flow in different ways.
Well, that covers everything we wanted to discuss about putting together your student loan game plan. It's definitely a complex topic with a lot of moving parts, but hopefully this was helpful in giving you some things to think about and some questions to consider. Student loans are such a big part of financial life for so many younger physicians, and we just want to make sure people understand their situation and their options and are able to figure out the right strategy for them and one that has some thought and attention behind it. And just to summarize the key points from our discussion, you want to start by understanding whether your loans are public or private. If your loans are private, look at your options for refinancing them to lower your interest rate. If your loans are public, decide whether or not you're going for PSLF. If you are going for PSLF, make sure you meet all the requirements. And if you aren't going for PSLF, look at your options for refinancing your loans. And if you have loans that you're paying back and you're thinking about whether to use the available cash you have to pay ahead on those loans versus using it elsewhere, be sure to weigh both the quantitative and the qualitative factors, since both are important in the decision. Well, thanks everyone for joining us for another episode of the show. If you have questions to ask or feedback to share, please email us at info@mdwmllc.com. And as always, you can access the show notes by visiting the podcast page of our website at mdwmllc.com/podcast. And we'll include in there a couple dedicated resources on student loans, including the PSLF checklist we mentioned, as well as a one-pager on putting together your student loan game plan. Well, take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight for Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.